Hi there, welcome to our regular update on the UK economy. If you're taking exams, maybe A-level and IB economics, this is a great chance to update your knowledge and awareness of what's happening in the British economy at a key point, maybe even a turning point in the current economic cycle. We know the UK has been hit by several external shocks that emanate from outside the UK economic system, obviously including the pandemic in 2021 and then more recently the energy crisis. And that created the risk of a period of stagflation. We then saw the very steep increase in cost and price inflation in 2021 and into the autumn of 2022. Inflation seems to have peaked at about 11%. It's now falling. Inflation falling, we call that disinflation. And the latest figure is 4.6%. That said, it doesn't mean prices are falling, they're rising less quickly, and inflation is still more than twice the official target. It looks as if recession will be avoided in 2023, but underlying the situation underneath the surface, if you like, real incomes are still falling and taxes are rising. And of course, with central banks, not just in the UK, but across the world, raising interest rates recently, the lagged effect of that tightening of monetary policy will continue to be seen in 2024 for both households and, critically, tens of thousands of businesses. Now, despite the tax cuts, we'll talk about the autumn statement in a few minutes, the UK tax burden, the overall tax revenues as a share of GDP, continues to climb, and the tax burden has reached a 70-year high. Okay, so what's happening to the UK? Let me take you through some of my key charts here. And again, if you want to take a screenshot at any moment, just press the pause button. Maybe if you're taking some notes as well. So here's the chart for UK inflation showing that steep rise in inflation from 2.6% in 2021 to an average of 9.1% last year. Of course, the peak in inflation was 11%. Inflation in 2023 is likely to average 7.5%. It's now below that figure, but I put in there the inflation target for you, which remains 2%. And of course, one of the key reasons why inflation increased so sharply was the steep, unexpected, but huge increase in the world price of gas. So this is the price of gas, pounds per therm. And you can see we had a decade or more of relatively cheap gas. And then suddenly the price climbs massively. Now, the price of gas is well below what it was 2 years ago. So you would expect that to be a key cause of disinflation in the economy. Central banks, of course, including the Bank of England, increased interest rates as part of a tightening of monetary policy in order to bring down inflationary pressures, both in terms of demand, aggregate demand, and also to try and increase the exchange rate and therefore bring down the cost of imports. So you can see what's happened to interest rates in the UK. They went up from 0.1% in the autumn of 2021 all the way up to 5.25% at present. Now, that's where they are at the moment. Some people think they might rise a little more. Others think that interest rates have now peaked. We've reached the end of the tightening cycle. But the key point, I think, is that although inflation is falling, interest rates set by the Bank of England will probably likely remain higher than they have been in the period after the global financial crisis. If you go back on this chart all the way back to 2009 beyond, interest rates have been 1% or less. So the UK economy is still in this phase of adjusting to a much higher level of interest rates. Perhaps the new normal for interest rates in the UK will be somewhere between 4 and 5%. And lots of different markets, from mortgages to bank loans to the cost of retail credit, they have to adjust to this new higher interest rate environment. Certainly something to be aware of. Of course, the lagged effects of monetary policy, those lags are uncertain, both in terms of timing, duration, and scale. Higher interest rates for households reflected in the mortgage market. Many people, by the way, on fixed rate mortgages having to pay much more for their mortgage both this year and next year. This just tracks the average mortgage interest rate across different 2, 5 year, 10 year, etc., fixed and variable. And you can see there's been quite a turnaround in the mortgage market. And we basically had a decade where mortgages were becoming cheaper in nominal terms. the rate of interest on mortgages was falling, and now suddenly we've moved into this new phase of much more expensive mortgages, adding hundreds of pounds per month to the interest bill paid by homeowners. And this is now starting to show through in the housing market. House prices are now, on most measures, declining. They're falling. What we're not sure about yet is the extent of the fall, the likely scale of the house price deflation, and also how far into 2024 this will continue. So if you look at this chart here, this is the same chart as we had before, showing the level of house prices on an index basis. And on the right-hand side, the rate of inflation of house prices. And it is indeed a decade or more since house prices were genuinely falling. But that's where we are as we head into 2024. So what are think about what are some of the consequences of this? Who wins and who loses from perhaps a year where house prices fall by somewhere between 3 and 5%. It does appear, though, that recession has been avoided in 2023. This is the latest data for GDP growth, published by the Office for Budgetary Responsibility after the autumn statement. And it shows the UK economy essentially flatlining with a growth of 0.6% in 2023. But go back 6 months, and there were fears that the UK would have a shallow but quite a prolonged downturn. So it looks as if the UK has managed to avoid recession in 2023. But avoiding recession isn't really the same as the economy growing. And this index of real GDP, I think, emphasises the flat, sluggish nature of growth in the UK at the moment. Just before the pandemic, the index there of GDP is given 100. That's our base value. You can see as we head to the end of 2023, essentially, 4 years later, the economy is bigger than it was 4 years ago, but only 2% bigger. And that's really slow growth. Obviously, we had the pandemic. You can see the effect there. And then the recovery, the 2 lockdowns. The UK economy has barely grown in the last 4 years. And people are feeling that in terms of their living standards. Unemployment starting to edge higher. You can see it went up to just over 5% during the pandemic. Of course, that was held down artificially by the very generous and expensive furlough scheme. Then it fell back as the economy picked up and recovered. And as we got into 2022, all the stories were about labour shortages and million job vacancies and a very tight labour market adding to wage pressures. Well, unemployment is now going up. It's now 4.2%, forecast to rise a little bit higher between now and the end of the year. But at the moment, the unemployment rate is low historically, and it's the labour market is holding its own pretty well. The big attention seems to be less the rate of unemployment, but the challenge of getting more people into work who are not counted as unemployed. So one of the current topics at the moment, which was featured in the autumn statement, was economic inactivity. And this chart, I think, is quite revealing. It shows the number of economically inactive people. So that's people who have working age, but are not actively looking for or searching for paid work. Shows the number of people who are economically inactive, who are inactive because of long-term sickness. And you can see there was quite significant progress over the last sort of 30 years or so in getting that down. From well over 2 million people in the mid-1990s to under 2 million in the period before the pandemic. And then suddenly, you can see the consequences since 2020. There's been a very, very steep rise, well over 500,000, perhaps 600,000 people who are now inactive due to long-term sickness. That is a major economic as well as a social issue. Some of it related to long COVID and the chronic illnesses associated, other illnesses associated with the pandemic. So whilst unemployment is going up a little bit, but not very much, that rise in economic inactivity, I think, is something that the top students are aware of, because these people are not in work and not searching for work. I mentioned living standards a few minutes ago. The economy flat in terms of growth, but real incomes have taken a hit. This data shows the annual real household disposable incomes. So that's real, adjusted for inflation, of course, disposable income after direct taxes and benefits. And I've put a couple of labels on there that average disposable incomes, 21,000, just under 22,000, in 2021, has fallen by £600 between 2021 and 2023. So that is quite a sizable fall in real take-home incomes, and people are feeling it. Over the last 2 years, taking the last 18, 24 months, prices have risen by 16%. Food bills have gone up by 28%. Average earnings have gone up, but not as much as prices. So that's why real incomes have fallen. And of course, taxes have gone up. And that's what's cut into disposable incomes. The Resolution Foundation published a revealing chart just after the autumn statement where they tracked the total growth in per capita real disposable incomes across each parliament. So you can see on the left-hand side here the Prime Ministers, starting with Eden Macmillan and then all the way through to the most recent parliament where we've had Johnson, Truss and Sunak in office. And this, they say, will be the first parliament in modern times where people will be poorer at the end of the parliament than they were at the start. Another big issue recently has been the increase in the minimum wage. I've done a video on this, separate video if you want to check out some of the economics of it. The government has raised the minimum wage quite sharply twice in the last 2 years, partly to reflect inflation, partly to improve work incentives, and partly an attempt to try and increase the take-home incomes of younger people. So you can see now that the minimum wage from April next year will be £11.44. They've brought together the 21 to 22 and 23 and over group. That's now one category, with the apprenticeship rates now rising to £6.40. That's quite a big rise in minimum wage. And that has consequences, particularly for people in the lower income deciles, those in work on below average wages. What about fiscal policy? Well, we know that the pandemic had a huge effect on the amount the government borrows. This shows government borrowing as a share of GDP, jumping from just 2.7% in 2019-2020 to 15% of GDP during the full year of the pandemic. Since then, obviously the furlough and the loss of tax revenues contributed to that, but since then the deficit's come down, 5.2% last year, 5% this year. So the deficit is coming down, albeit slowly, but because the economy is not growing very much, debt as a share of GDP remains higher. So this chart shows net debt as a percentage of GDP just under 100%. It's about £2.6 trillion. If you take off the debt held by the Bank of England, it's a lower figure, about 92, 93%. The reason for showing this chart is that the level of national debt in the UK is way higher than it was, 20 years ago? If you go back to 1990, 2000, the national debt in the UK was around 30-35% of GDP. It's essentially now trebled as a share of GDP. And as a result, the amount of debt interest that the government is paying has climbed sharply. We think the forecast is that in 2024, the UK government will pay £120 billion in debt interest. Now, excluding welfare, it's only the NHS that is a bigger spender. So in other words, debt interest is now essentially the second or third biggest element of government spending. £120 billion, or expressed another way in this chart, that's debt interest as a share of GDP will climb above 4%. And adding in this chart, debt interest payments by the UK government will be over 10% of all its tax revenues this year. Interesting. Partly, it's because the rate of interest the government is having to pay on debt is going up. So this chart shows bond yields. You may well have covered this as part of your studies. It's not the only country where bond yields are going up, but you can see here that the government's having to spend more, pay more in interest as a percentage on the debt that they issue, including Japan, where inflation is returning after many years. Now, I just want to look very briefly to finish with taxation. So this is a really key idea. The tax burden is you take all the taxes that are coming in, from income tax to VAT, corporation tax, national insurance, all the taxes, you add them together, express it as a share of GDP, and you get something called the tax burden. And this chart goes all the way back to 1948. So we're coming out of the Second World War back in the late 40s. And you can see that the tax burden in the UK is now at the highest figure it has been for 70 years. So this combination of slow growth and higher taxes is causing the tax burden to rise. Partly, it's to do with fiscal drag. Now, this is, again, a concept in the media at the moment. Not many people understand it. Let me have a go at explaining it for you. The government has essentially frozen the allowances for different tax bands. So you can earn £12,570 before you start paying income tax. Great. However, with inflation, people are earning more, wages are going up. So people who were not paying income tax before now pay income tax at 20%. People who are just under the top rate band, £50,000, get a 10% pay rise. That lifts them into the higher rate of income tax. So in a world of inflation and rising wages and prices, people get dragged into paying tax and tax at higher percentages. So you can see here over the period where tax allowances are going to be frozen for the next 5 years, something like 4 million new taxpayers have been brought into paying income tax. Something like 3 million people who are existing taxpayers are now paying at 40%. And a smaller number, but not a substantial number, now paying at 45%. So fiscal drag is dragging millions of people into paying more tax. Consequence is the government gets a lot of extra tax revenue. Inflation increases the revenue that comes in from direct taxes. Something like an extra revenue in excess of £44 billion in 2028 to 29. So fiscal drag is a big earner for the government. Some people call it stealth tax. Others call it fiscal drag. Exchange rates, not much to say on exchange rates. The pound is relatively stable against the euro. Check along there, that sort of 120. It's still relatively stable against the dollar. The pound has been held up a little bit by the rising interest rates. So the Bank of England increasing interest rates there to 5%, 5.25%, has helped maintain exchange rates value. And a stronger pound in some sense has helped keep inflation a little lower as well. Although it's made life harder for exporters. Just finally, a quick look at the autumn statement. We're expecting a budget early in 2024, perhaps the last budget before the election. But this was Jeremy Hunt's autumn statement. They announced a 10% rise in the minimum wage. We've talked about that. They cut employees' national insurance by 2%, so a direct tax cut. But keep in mind that's dwarfed by the fiscal drag effects of freezing tax allowances. A couple of things they did. They made permanent the full capital expense scheme for businesses. Government's worried that business investment's low as a share of GDP and it's holding back growth and productivity. So firms, including small businesses like Chew, here I am in the studio, that allows firms to write off the cost of spending on new machinery, new screens, new computers, new microphones, etc., against their corporation tax liability. So that's basically a subsidy, a tax subsidy, if you like, on investment. And that's been made permanent. And that should, in theory, stimulate investment by small businesses in particular. And the government is very keen on free ports, investment zones, special investment areas. They've added some new zones to their list in different parts of the country. And they've gone from 5 to 10 years in terms of the range of financial incentives on offer to people who invest, businesses invest in those areas. So a budget for growth, but as we know, the growth in the economy is not just the result of fiscal tinkering. It's fundamentally about productivity. It's about skills. It's about demand. And it's about being competitive in the world economy. There we go. Quick look at the UK economy. Hope you found this useful. Stay tuned on our daily blog for daily updates on the UK economy. And thanks for joining in. See you soon. Take care.